with all of that, what we're going to do is we're going to try and get you how the market is really set up at this juncture and how do you play the market. And for that, none other than Vinod Karki joining us. He's head of strategy, ICICI Securities. Vinod, great having you. The macro first, Vinod, and you have that great understanding of both the macros as well as the micros. So let's start top down. Just with regard to the US bond yields have been fluctuating quite a bit as well. We had that play out this week. US debt is one of the concerns. The other concern is inflation not really cooling off, right? How large do you think the risk is of the US 10-year bond yield going higher from here? And if so, how much for how long?
Yeah, thanks. I hope I'm audible.
Very audible, Vinod.
Yeah. So as far as the US bond yield, which has been rising, I mean, it is more than rising. One should read it as, I would say, steepening of or normalizing of the yield curve. So if you remember, 3 years ago, the constant narrative was that the yield curve was inverted in the US, which was typically a precursor to recession that has been the case in the past. But now it's normalizing, so the longer term yields are higher, and in fact, the 30-year is at almost 5.3%, which, if you look at, it was a similar number way back in 2000. So I think two ways to read it. One is that yield inversion, which meant that the US could get into recession, that is out of the way. So which is good. Investors are, asking for higher yields for longer dated maturity because they feel that growth will be picking up in the future. So from that perspective, a normalizing of the US yield curve is, in my view, positive that way, driven by, the US economy continues to be robust instead of going to recession, driven by all this capex that we have been seeing in the AI space and things like that. But the second order effect, obviously, is that the risk-free rate, that goes up. So the discount rate for all asset classes, including equities, it starts to rise, which doesn't allow the multiples or the PE multiples to rise. We in the past, if you see the post-global financial crisis, we had this situation where bond yields almost fell to zero in the US, and that actually created an environment where, especially the low volatility stocks, as they are called, their PE expansion really went up, and so this will be an environment where only the growth companies which are having good growth will continue to sustain valuations. Valuations will not be sustained just basis of low volatility in earnings, or just because you have higher ROE but no growth. Those kind of things will not be sustainable in this new environment. So yeah, two ways to read it. One, obviously, that growth is going to be better, not a recession in the US. Secondly, that you better grow, because if you're not growing, you won't get the multiples in this environment of rising interest rates.
Point taken. Hi, Vinod. This is Nehi also joining in. Now, you've said that India's equity risk premium, that continues to be pretty low. What is the scope for re-rating for Indian equities going ahead, and what could be the triggers that could lead to that?
So this is very interesting point, which we realize when we're doing an analysis, is that, when the mother of all markets, US, the risk-free rate goes up, typically the other emerging markets and all, their risks, the spread rises actually. The bond yields rise faster. But if you observe right now, the spread of the 10-year bond yield in India versus the US, the spread is almost at a multi-year low. So and the credit default swap spread of India over US is also at a multi-year low. So effectively, what the global investor is saying, that India risk premium as a country is lower, much lower. Fundamentally, while the risk-free rate is rising in the US. So I think it kind of there's no scope for PE re-rating that way in this environment where the base rate, the base risk-free rate is rising, but it kind of offsets, because India, we started to get some flows also of late, and this risk premium not rising suggests that investors will be looking favorably provided India grows. So in this environment, the key factor to watch out is growth. If you're not growing enough, higher discount rate will ensure that you get lower multiples.
Suppose, therefore, Vinod, I would suppose that you wouldn't look at IT stocks favorably because of growth. And second, dividend yields will probably go out of the window, just given the fact that the risk-free rate itself is at near 5%. And therefore, value will have a slightly different definition, and dividend may not be something that one would want to look at, like the way one would look at typically across the last 20 years in terms of cycles.
Yeah, so I think that typically, if you see, if you especially after the global financial crisis, what happened is that the cyclical part of the economy, where the balance sheet driven companies, be it industrials and others, their growth faded, and on the other hand, you had these low volatility stocks, be it IT, FMCG, or some of the other stocks, where the growth was reasonable. It was not stupendous. But what happened was the discount rate fell to such a level that investors gravitated towards the so-called low volatility stocks. Now that won't work in this environment. You need to have high growth companies for you to sustain valuations. And I think the growth is coming largely in the cyclical stocks, which I can see. We did an analysis of where the top line growth is more than 20% YOY and QOQ 4-5%. I see classically two types of sectors were there. One is this new age sectors, which are growing much faster than the rate I just mentioned. And some of the old economy stocks, not old economy as such, but the cyclical stocks, autos and some of the industrials and discretionary consumption, financials, their growth is much better. So I think that's something which you need to, you won't be able to hide behind just low volatility earnings,
So that's your take on IT. And Vinod, you did mention a bunch of sectors that are looking good to you. And among them, you spoke of consumer discretionary. You've spoken of platform companies. Now, a lot of platform companies are an indirect play on consumption. How are you looking at that entire theme? And what would your view be on consumption staples?
Yeah, so if you look at just the staples, actually, there are, clear and present danger, if you would say. In one of our recent research, what we have highlighted is that we are currently facing a super El Nino year, and it is going to worsen as we end the year and go into summer of 27. So you could find yourself in a situation similar to 24, where you had a very hot summer in north of India, and agriculture output virtually came to a standstill. Stocks which are exposed to the rural consumption, especially the agrarian economy, I think there the concern is very clear. Obviously, you'll have some offsetting effect of the pay commission and the things. Elections also around the corner, so I think there will be some respite there. But fundamentally, the agriculture sector faces a risk, in my view, in this environment. So that's the concern on the broad FMCG space. But in general, the discretionary consumption driven by the not related to agriculture sector people in the economy, where the incomes are rising, especially in the cities, and so I think that will continue. And these new age companies, some of the even older age, old economic companies, which are catering to these cohort of consumers, where it's not only it's premiumization and trying out new products. Income is also growing there, so I think that dichotomy may be there going forward.
Vinod, I'll stick with consumer discretionary, and within that basket of quick commerce and the platform companies, I see that you have the number 2 player instead of the number 1 on your list. Is that purely kind of the discount multiple at which the number 2 player is playing versus number 1, or how should one kind of contextualize that? You prefer, say, Swiggy over Zomato. That's my understanding.
Yeah, so I won't go into stock specific, but
Sure.
if you've been observing our model portfolio, I mean these it's not as if these are the top picks kind of thing, So it's not as if one the other is not a buy or that kind of a thing. It's more to do with, as you said, some valuation gaps here and there. We like the whole, I mean, both the stories overall, and so I think I mean, what happens is at times one stock runs up and the other doesn't to that extent, and relatively it's better off. So to that extent, there would be these names figuring up. In an earlier month, the other company would be there or thereabouts.
Okay, and Vinod, while we're talking of discretionary consumption, the other sector that comes to mind is auto. How are you looking at automobiles? Because, of course, with the three-wheeler and the tractor segment, we'll have that El Nino factor at play. But otherwise, do you believe autos are better placed than ancillaries? Is it the other way around? What are you liking within autos?
So I think the whole auto pack is growing well, I would say, overall, especially the companies which are positioned towards, I think, the discretionary premiumization kind of consumption rather than again, the same picture of, rural, going at the base model kind of consumption. It's people want premium, good looking bikes or, good looking cars, or some of these companies are showing good exports growth also, and expected to further show a better exports growth in the future. So I think it's a combination of that. So I think so far it's a combination of both domestic premiumization, consumption, and export story, which is driving, I think, demand for the entire auto pack. I would say even some of the auto ancillaries and OEMs. Yeah.
We'll slip into a very short break, come back. Vinod, please stay with us. Viewers, you too. Plenty of conversation still left. I mean, there's so much to talk about. Private sector banks, industrials, some of the flavors of Q1 still needs to be touched upon. We'll talk about those with Vinod in just a bit.
Back with Market Edge, and we're in conversation with Mr. Vinod Karki of ICICI Securities. We've touched upon a bunch of sectors like consumption and some other names, but let's also talk about financials. Vinod, how are you looking at the entire financials basket? What's the tilt in terms of your preference between private banks, PSUs, as well as NBFCs? Are you cautious on any pocket within that sector?
Yeah, so I think financials is an interesting space overall because it fits the criteria of what I said, where growth is picking up. So if you remember, just about the same time last year, the credit growth was almost single digit, I would say 9% thereabouts. From there, it went to 10, 12, 14, 15, now it's almost 18, 19%. So I think structurally, we are entering a phase where, the credit growth is picking up. And good part is that earlier, whenever the credit, post the global financial crisis, the bulk of the growth pickup was led by just the retail lending. I think now we are seeing very strong movement in the wholesale, corporate lending, industrial lending, and all, so which is a very healthy sign because that's where. If you're just funding consumption, then that's not a healthy sign. But if you're funding the gross fixed capital formation, I think that's a very healthy sign. So structurally, what I've seen is that the capex cycle, when it starts, it continues for several years, like we saw between 2002-3 to 2008. So I think look at the three major indicators for financials. In my view, are one, you check how the credit growth is picking up. Secondly, you check where the NPA cycle is. So I think, and thirdly, obviously the interest rate cycle. So I think from all these perspectives, it seems like we are just picking up on the credit growth. We are at the bottom of the NPA cycle. So to think about it, the next peak of the NPA cycle will be several years down the line. And the NIM compression cycle, which we have been seeing in the recent past because inflation undershot, I think that is now behind us, we'll actually start seeing some inflation, and the NIM compression cycle may more or less be behind us. So I think, and the corporates have started to borrow, I would guess. So I think they are good. I mean, well positioned, and the prevalence of fintechs which are distributing loans at a rapid pace for the lenders, that also helps. I mean, overall, accelerating the growth. So I think this is a good space to be in, and thankfully, the market is not euphoric in this space at this point in time. The valuations are reasonable, especially the large banks, for various reasons, including management issues and things like that. But eventually, the broader cycles decide how an asset class performs. So from that perspective, very confident on the overall banks, be it the large banks, even the NBFCs, which are growing at a fast clip while controlling their NPAs. I think it's a good space to be in.
Talk to us about industrial and cap goods, because that seems to be a slightly different story, right? The valuations have run up. Probably a few years of earnings growth has been built into those valuations. How do you rationalize that, and where do you stand with regard to industrials and cap goods? Vinod, I'm not sure if you caught that. With regard to industrials and cap goods, valuations have run up a wee bit, a couple of years of probably earnings priced in. How do you look at them now at this juncture?
Yeah, I think it is expensive, no doubt about it, and a lot of it is caught in the valuations. So you have to be very choosy here, and in fact, some of the largest companies at times I see that So you have to look at the multiple you are paying and the growth you are getting. So some of these large companies I see, if something is at 25, 30p and it's growing at 15-20%, then it's fine. But once you go beyond that 50, 60, 70p, and with growth similar to 15, 20% and all, the PEG ratio goes out of whack. I think that's where you have to be careful. If you're getting something in the range of the earnings growth and the multiples, the PEG ratio rather in the range of, you'll not get like a 20p and a 20% earnings growth. But even if it is 30 times, but 15-20% growth, I think there are a handful of them. So you have to be very selective here, because why the market is giving these multiples is because the growth is sustainable. That's the thing. But you may end up overpaying for that, and typically that has led to investment mistakes in the past.
Okay, understood. So that's on the entire cap goods space. Vinod, also, what is your view on pharma? Now, there have been themes that have been, they've seen their time in the sun. First, you had the entire diagnostics wave that came in, and then you had CDMO and then GLP. Do you believe that these themes within pharma are sustainable for continued earnings growth, or do you believe that there is a need for revival within pharma, because we've of late seen a little bit of a mixed bag in terms of pharma earnings?
So I think pharma somehow has been always a mixed bag. It is not. It has always been, some companies doing well, the others not doing well, and those kind of things. But to answer your question, I think there are some structural themes which are, which like you mentioned, some of them, the GLP or the CDMO and all. I think, but you need to be careful in terms of, see, what happens is when you say, banks, for example. So when the credit growth is 17-18%, roughly, if you'll see, most of the banks would be in that same region. It's not as if one bank, unless it is undergoing some serious trouble, which obviously everyone knows. But for pharma companies, it becomes quite stock specific that way. So you have to have a very good understanding about what the company does, where it's what you should say, customer base is, how the pricing power and all those things are there. And we have seen several instances where, some companies doing really well, some poor, some doing very poorly, and those kind of things. So you need to have a good lens over there, good understanding of their markets, their products, their pricing power, what's going wrong. I mean, you get those warnings, safety warnings, and also I think that it's not as if one you can just take one call on that whole sector.
Okay, understood. That's a take on pharma. Vinod, I wish we could extend this conversation. Lots more to talk about, but due to paucity of time, we'll have to let you go now. But always a pleasure, always a good time speaking to you, and pleasure having you on the show today.
It was a pleasure. Thank you.
Thank you so much. On that note, viewers, up next, an exclusive roundup of the week's key developments from Maharashtra in our Maharashtra 360.